the system isn't working for the most number of people.
It's not.
For the average person, it's not working. However, for investors, the system's working quite fine as long as they keep priming the pump on asset purchases.
All right, everyone, welcome back to an episode of On the Margin. Today, I'm joined by Darius Dale. Darius, welcome.
What's up, Michael? How you doing?
I'm doing very well, my friend. I'm doing very well. How are you?
It's a pleasure to be here, my friend.
Yeah.
Every day above grass is above this on this side of the grass. Rather, is a good day.
Indeed, it is. Indeed, it is. A lot of perspective. So usually I wait till the end of this, but you, I know, just went out on your own. Started 42 Macro. So give us the plug before we get into it here. Tell us a little bit about what you're doing right now.
Yeah. So, I mean, at 42 Macro, I mean, our mission is pretty simple. We want to democratize the institutional grade macro risk management processes that a lot of the most followed buy side firms and asset managers are using. Democratize those processes for all investors. I believe there's a lot of macro opinion out there, and quite frankly, I do believe that the world is really devoid of macro process. And so what we do at 42 Macro is really crunch all the numbers and the data for investors such that they can follow along and actually appropriately risk manage their capital across economic and market cycles.
Yeah, that's great, man. I'm super happy to support that. It's so hard to get good information out there. Like, even we were just talking before we came on here, super basic stuff. Even something like QE is just completely misunderstood, and
Totally.
Nothing that fundamental there should be questions around. So with that being said, I want to just get right into it. Let's kind of start at this idea of reflation, right? So if you kind of go back to September, October, November of this year, the reflation trade, the reopening trade was kind of all the rage. It's seeming like that's died down a little bit, and obviously there are fears about the Delta variant kind of flaring up. Jackson Hole is being recorded virtually, not an in-person meeting, maybe for the first time ever. So talk to us a little bit about where you kind of think we are in this reflation trade, reopening in the economy, growth, all that kind of stuff.
Yeah, so this is something we called out in real time and really prospectively going all the way back to May, in the early parts of our existence. The inflation trade is over. Let me start there. The inflation trade is definitely over. And at least it's taking a temporary pause for those of you who are more longer-term investors, because I do believe that there is a longer-term opportunity there. However, I tend to take offense with, the investors that say, hey, the markets are devoid from economic fundamentals, because the reality is the reflation trade pretty much ended right when it should have ended. If you allow me to share my screen, I actually prepared a slide deck for you.
Yeah, that'd be great.
You guys are more than welcome to distribute. All right, so let me start by saying we think about the world through the lens of regime segmentation, and the two most important factors that matter to asset markets in terms of them being principal components of asset class dispersion, both in and across asset classes, is growth and inflation. And so we think about the world through this regime segmentation lens, whereby you wind up with four states. When growth's accelerating and inflation's decelerating, that's what we call Goldilocks. When growth and inflation are accelerating simultaneously, that's what we call reflation. When growth's decelerating and inflation's accelerating, that's what we call inflation. And then lastly, when both are slowing simultaneously, we call that deflation. So the short acronym for this is GRID. We call this our grid system. And looking at slide 5 here, the most important thing you should fundamentally focus on when you see this chart is just the colors, right? Like, we went from deep dark blue deflation in the winter and spring of 2020 to this very elongated stretch of dry land, whereby growth and inflation were persistently and consistently accelerating, not only in the U.S. economy, but really all across the world economy. And now, as you can see, as we're getting into the latter part of the third quarter of this year, we're about to go back into the water again, in terms of heading back into what we call deflation again, when growth and inflation are trending lower simultaneously. So as you might notice, and everyone noticed this, the reflation trade pretty much ended in June. It didn't pretty much end in June. In fact, it actually did end in June. It no longer was the modal outcome from the perspective of our market regime nowcasting process. And so each of those regimes I just highlighted has a sort of very pretty consistent set of sector and style factor leadership, of cross asset leadership from the perspective of asset markets. And as you can see, really going all the way back to November of last year, reflation was the dominant market regime. It was the modal outcome from that bean counting perspective. Well, as you can see in early June, it really dissipated. It gave way to Goldilocks, and since then we've been having this sort of debate between Goldilocks versus deflation, but ultimately we think Goldilocks will win out, at least over the next couple of months.
Yeah. So Darius, kind of walk me through, maybe you can, looking at this through your sort of framework that you've laid out here, it seems like one kind of narrative that you hear, sometimes explicitly said, sometimes sort of implied, is that, look, like you said, the equity markets are not being rational right now. There's all these kind of sky high valuations, these growthy tech stocks. They have to correct at some point, right? On the one hand, I could see that being true, right? That if you look at the Nasdaq, it just looks like tree can't grow to the sky forever. Like what goes up must come down, at least to some degree. On the other hand, to maybe look at this through your framework, it doesn't look like we're really moving back to a place where growth is the status quo, is what we expect. So in that case, that kind of dynamic of paying a premium for growth should continue, right? So we should see an extended rally on some of these tech stocks, riskier sort of growth names. How do you kind of answer that or think about that question?
Yeah, that's exactly what you should see. So going back to that table I highlighted, where we're heading into a sequence of Ds. When you look at what it historically has led from a style factor leadership perspective, the number one style factor you should be long of in deflation is large cap growth. Right, like it's when growth is scarce, investors assign a higher premium in valuation terms to assets that can compound sales and cash flows, and so that's precisely what we observed over the past sort of month. Really, it's been 2.5, 3 months going on, starting in early June. You've seen persistent leadership from large cap growth, low beta type sectors. That leadership has really gotten defensive in recent weeks in terms of utilities and healthcare being really at the top. But really, since the early part of June, you've seen a tremendous. So actually, what I'm showing here in this chart, let me explain the chart first on the right here. We're looking at the month-on-month Sharpe ratios across 50 different equity sectors and style factors, and so we track this on a daily basis to identify, in real time, what grid regime is investor consensus either being rotating into fundamentally, or they're being rotated out of, based on the risk management systems that you typically see at multi-manager hedge funds. The key takeaway is that it's been going in the direction of deflation, again, growth and inflation slowing simultaneously for 2 months now. And so we would expect that to continue to a certain degree, although we would expect in the context of a Goldilocks regime to see a little bit more balance and a little bit more participation from cyclicals that we've seen in recent months as a function of the market regime transitioning back to Goldilocks.
Yeah, absolutely. So I guess another question that I have as well is people kind of are all eyes on the Fed right now. So we just talked about their upcoming meeting in Jackson Hole, right, which is going to be virtual sort of for the first time. There's a lot of talk kind of about the difference in between. I guess another narrative that I'd love to get your opinion on is we've kind of exhausted what we can do from a monetary policy standpoint, right? And we're starting to see fiscal kind of come in in a big way, right? It's hard to even keep track, right, of all the different iterations of the infrastructure bill. But I think we had like $1.5 trillion infrastructure bill that was passed. What are your thoughts on kind of how much do you pay attention to kind of monetary versus fiscal spending? Where do you think we are kind of in that sort of cycle?
Well, I'll tell you where we better be.
Yeah.
Where we are and where we better be is two very, very different things. So let me start by the first part of that question, which is on slide 58, I believe. Let me jump ahead. So the Fed has a history of prematurely tightening. What we're showing here in this chart is the Fed's balance sheet relative to financial conditions. And so if we don't see the continued handoff from monetary to fiscal policy, what you're more likely to observe in asset markets is something that looks a little bit like 2010 or 2011. Remember, we had the drawdown. It was 16% in 2010 when they ended QE1 prematurely. It was 20% in the S&P when they ended QE2 prematurely in June of 2011. So, there's a history of the Fed sort of pulling back on monetary accommodation before the economy really gets to a place where it's self-sustaining, really kind of reflexive economic cycle to the upside. The reason I bring that up in terms of where they better be is because when you look at some of the more secular drivers of monetary and fiscal policy dynamics, if you think about what we look at as politics, we're showing here on the x-axis, the Gini coefficient, which is a measure of income dispersion. Higher is more unequal, lower is more equal. And then on the y-axis, we're showing the unemployment rate. And the reason we show those two variables together is because it gives you a good proxy or quantification of, particularly relative to other economies, the amount of political risk that you have in any given society. This is really the fodder for populism to the extent your dot is up and to the right on this chart. And so as you can see, where our dot is currently in the United States, we've really separated from the pack from the rest of developed markets, the rest of the Western world, from the perspective of this political risk. And the reason that's important is because a lot of what's driven that, if you think about the breakdown in the relationship between labor and capital in the United States society, that's what's driven the location of our dot on that previous chart. What I'm showing in this chart here is corporate profits as a percent of GDP relative to employee compensation as a percent of national income. And as you can see, that was a long and healthy, stable relationship. It was cyclical, as it always has been, throughout since the dawn of time.
Right.
However, it was a long, healthy, stable relationship. Well, starting in really the early part of the 21st century, you had China join the WTO in November 2001. You had the sort of the onset of the internet and internet commerce and all that jazz that came with it, and then you also had the proliferation of low interest rates and because of that the proliferation of the private equity industry and all these things. They've all basically laid siege to the amount of compensation and the share of national income that was being garnered by workers. And so to me, this is why we kind of are having these discussions about this sea change in fiscal policy, or this they better have this sea change in fiscal policy, because if you don't get it, what we're going to see is a lot more of what we saw last summer and a lot of what we saw in the early part of January, in terms of both sides of the aisle being pissed off and fed up enough, as a function of being left behind by this style of economic development.
Yeah. Man, those are some really great charts. That Gini coefficient chart, I'm going to have to take a deeper look at that. I love the way you laid this out, because to me, a lot of this comes back, almost everything comes back to, a lot of these types of discussions tend to be centered on, are we going towards inflationary environment or a deflationary environment? And for me, I think the more important question to understand there is, it all comes back to income inequality, right? Wealth inequality. Because as long as you have that for sustained periods of time, you can just look throughout history, that never lasts. That literally never lasts. Something has to change, right? The most, the least extreme way that could change is maybe there's a shift in labor to capital, which is what I want to ask next. But the most extreme is like the, French Revolution heads on spikes, which I'm not saying that we're there yet, but, always good to be cognizant of. So could you go back to that, the labor versus capital chart that you had there before?
Yeah, absolutely. Sorry, my apologies.
No. So here's my question for you here. So if you look at kind of how empires structure themselves, one component of successful empires is they have access to really cheap labor. In the past, that has been basically forced labor. You can make the argument that for the United States, what we've essentially done over the last 30 years under the banner of globalization, right, or outsourcing, is we've taken in this huge, super low cost labor pool in the form of China, right? So on the one hand, when I think about where we're headed in terms of being in a secularly inflationary or deflationary environment, we're printing all this money, right? So how could we not be headed towards inflation? But on the other hand, we still have these gigantic low cost labor pools. Even if China were to, their cost of labor were to go up, there are other places in the world that I think we would just relocate to. So how does this dynamic of share of income, right, for the United States change if there are still these low-cost labor pools that exist, be it China or maybe if we move to Vietnam or Mexico or other places? What's your thought on that dynamic?
Yeah, no, that's a phenomenal, loaded question.
I know. Sorry, it took me about 2 minutes to get that one out. So
No, please. I appreciate it. It's a very thoughtful question, and I think there's a couple tenets that I really want to highlight. So let's start with this sort of concept of we have, I think you sort of alluded to this, and I'll spell it out a little bit more. I think what you're effectively saying is that a lot of the dynamics that have caused disinflation in the past few decades have not changed.
Right.
Yes.
There's
nothing new about that, and I would agree with that. So if you look at what I'm showing here in this chart here on slide 43, the red line is employees, the compensation of employees relative to the consumption of fixed capital. Mm-hmm. And as you can see, that's just been a one-way ticket. Obviously it has these sort of secular bottoms or cyclical bottoms, but it's been a one-way ticket lower for several decades now.
Yep.
And then the blue line in this chart shows the market cap of the S&P 100 index, so the 100 largest companies in the S&P, divided by the market cap of the S&P 500 index. And what you can see is that chart is up and to the right. And so what this chart effectively describes is the fact that the U.S. economy, and particularly the U.S. labor market, is increasingly dominated by monopsonies, and it's increasingly dominated by a broad-based preference for capital relative to labor. And so that's important to think about in the context of, all these sort of secular drivers of inflation, or disinflation rather, are pretty much intact still.
Yep.
If you look at labor force participation rates on its lows still, the velocity of money, it's on its lows, and then still structurally secularly elevated is the amounts of goods and services that we import from abroad. And so that to move this to the China discussion, it's we can definitely start to shift our production of goods to other economies at the margins. Obviously you can't do it overnight. You're going to cause supply chain imbalances like the ones we're currently observing. But certainly, there's this gigantic pool of excess labor out there waiting and ready and willing to finance cheap consumption of goods in the United States of America. That's not going away unless we start to levy incremental tariffs or change the nature in which we operate, in the global economy, which I highly doubt we're going to do. So to answer your question on are we headed for inflation or are we headed for disinflation, I think you kind of have to think about where we're coming from and where we've been, right? So this is what we're showing here is just the time series of U.S. headline CPI. The chart on the left is a 30-year chart. Chart on the right is a 5-year chart. And what you can see is that, yes, our models have inflation peaking, rolling, and decelerating over the course of our next 12-month time horizon. However, when those models start to bottom in the middle of next year, they're going to be bottoming at levels that are much higher than the bottoms we've recently observed in the past few sort of rate of change cycles that we've seen in this time statistic or in this time series. So what that means summarizing that, it means that the stationary mean of inflation has transposed itself higher. It used to oscillate around 1.5% for headline CPI, around 1% for core PCE. Those numbers are going higher, probably by 50 to 150 basis points. And that, to me, is a dynamic that the market doesn't have to price in now. And really, I think what the market really is pricing in is the peaking and rolling of inflation. But at some point in the next 12 to 18 months, we're going to be fully back on with this sort of transition to, reflation, commodities, sell bonds, interest rates are going higher. A lot of the stuff that we saw from November through early May, through early June, will likely start to come back on. But again, it's just, you got to manage the rate of change cycles, which is why we use that grid process.
Yeah. That actually kind of led perfectly into the next question that I have, which is, something else that was started to become popular around October, November. It's hard to remember time this year. What even is that? Is this phrase commodity super cycle, right? Everyone's like, we're going into the next commodity super cycle here. This started around when, lumber kind of began its parabolic rise, right? And what you've started to see is some of those commodities that grabbed a lot of news headlines, people are paying a lot of attention to. I saw this chart get posted on Twitter today. We're recording this on the 23rd. Lumber has essentially made a round trip, right? So it started to, it's kind of parabolic rise in around September, I think, of last year. And now it's right around where it was or even lower. And there are some other commodities like that as well, like steel's the most recent one to kind of go up, but it looks like it's coming back down as well, iron ore. So what are your thoughts in general about the price of commodities, right? Does it kind of depend on whether or not we're in this reflationary environment? Do you think prices are going to continue to rise? What are your thoughts on the whole commodity super cycle thesis, however many months we are out?
Yeah, I think it's a fair thesis, but I mean, nothing goes up in a straight line, as
right.
You can see from the red line here showing the CRB index, which is the broad basket of commodities, and the blue line is the U.S. dollar index. It literally did go up in a straight line.
It's a good point.
Up into the highs of earlier this, the second quarter of this year. And so there's clearly naturally going to be a pause, and really what's driving that pause, again, from our perspective, our framework, is the fact that the rate of change of growth and the rate of change of inflation are now slowing simultaneously as opposed to accelerating simultaneously. But in terms of getting a super cycle in anything, you got to start any sort of super cycle discussion in our industry with what is your secular outlook for the U.S. dollar? The U.S. dollar is the residual, the price of the U.S. dollar, in our opinion, is the residual of the imbalance or the lack thereof between supply and demand of dollar-based credit, both domestically and abroad. That's a mouthful. So let me start out and say that again. The U.S. dollar is the residual of the supply and demand imbalance or lack thereof between of the supply and demand of dollar-denominated credit, both domestically and abroad. And so if you have to, and the reason I say you have to start any discussion of a super cycle with what is your long-term view on the dollar, because if your long-term view on the dollar is bullish, then you're talking about disinflation. You're sending disinflationary signals to the bond market. You're sending disinflationary signals to risk takers in commodity markets and obviously in equity markets. And if you have a secularly negative view on the dollar, if the dollar is trending lower, it's naturally going to reprice financial assets and commodity assets higher, as most of them are denominated and traded in dollars. Commodities, upwards of 88%. Financial assets globally, you're talking about 50, 60% are denominated in dollars. So you really do need to have a view on the dollar. We do have a view on the dollar. Bullish on it in the near term, having been long the dollar since early June. However, over the long term, we're quite bearish. I think a lot of investors are on both sides of that camp, but I think there's a much more work on the secular bear case for the dollar than there is on the secular bull case for the dollar. And I tend not to want to be consensus. I really don't care what consensus is doing at any given moment. I care how their consensus is positioned, because positioning actually matters. But in terms of the longer outcome, the longer term view, you got to start with balance of payments risk. What's the current account? Let's go back to the currency fundamentals. What is the current account balance? Where's it going to be in 3 to 5 years? What's the sovereign fiscal balance? Where's it going to be in 3 to 5 years? And as you can see, the U.S. dollar, the U.S. we are the dirtiest dirty shirt in the laundry hamper with respect to currency risk. And the reason this has not mattered in 2021 is because you've seen an exceptionalism with respect to U.S. growth and U.S. inflation statistics that's pulling forward the likelihood of Fed tapering and tightening of monetary policy at the margins into the end of 2021. You don't necessarily have similar dynamics occurring in the UK, in the Eurozone, in terms of the ECB. You don't have it happening in Japan. You certainly don't have that happening in China. And so the dollar, from a relative, real interest rate and really shadow policy rate perspective, has really benefited year to date. And so the real question is, what does the world look like post-COVID? Or more, I don't actually believe in the phrase post-COVID, because I do believe the pandemic has become an endemic, and we just have to acknowledge that and start to shift the way we do things in society.
Yep.
But I'll leave that for a second discussion. Let me just sort of wrap up on the dollar. The reason we're so bearish on the dollar longer term, one, the currency fundamentals support that. Two, foreign central banks, and I'm showing here a chart of international reserve assets as relative to U.S. public debt outstanding. And as you can clearly see, they either don't want dollars, there's not enough dollar recycling in terms of buying the U.S. Treasury securities, or we're issuing Treasury securities so fast that they can't keep up. And so what this means is that you have to have a central bank, the Federal Reserve, i.e., has to actually absorb all that incremental Treasury supply from the sea change in fiscal policy that we previously discussed. And the reason that's negative for the dollar long term is because, again, you're going to have a central bank stay much more easy at every interval than they otherwise would be to capitalize the U.S. government. If they don't, and this is why, remember I asked the question, like, I'll tell you what they better do. If they don't, the problem is you're going to have a crowding out effect that starts with the federal government issuing bonds. The treasury market is at the top of the global capital structure. It's going to get its money. And so what that means is that the Fed isn't buying enough of that debt. Investors are going to have to sell other assets to raise cash to capitalize the U.S. government. And so that's a problem long term. In my opinion, I think part of the reason the reflation trade ended is that the Fed, in their June dot plot revision, the Hawkins revision to the dot plot, they effectively signaled that they weren't going to be all in terms of really aiding and abetting that fiscal largesse that we previously discussed. So the key takeaway for all this is that the dollar, which obviously was in a straight line down from May through January of this year, has really found a formidable bottom in this this price range. The red line on this chart has really found a formidable bottom in this price range as a function of the market realizing that, okay, this Fed is a little bit more like the Fed of old than it was that we thought it was in terms of the Fed, the new Fed, the asymmetric inflation or average inflation targeting Fed, the maximum inclusive employment mandate Fed is not that different from the Fed prior to that. And so the realization is that the dollar needed to take a breather in terms of its decline. But ultimately, once the rest of the world gets into this pandemic is an endemic state, or we actually emerge from the pandemic, you're going to see a pretty meaningful divergence between the monetary policy of the U.S. government relative to foreigners.
Yeah. I've got a couple questions for you there. So one, I'm going to try to channel my inner Jeff Snyder here, which is always dangerous to try to interpret what Jeff says. But so, you kind of started this out by saying that if you think about the future of the dollar, that essentially is a supply and demand dynamic in between the amount of outstanding, credit that exists, right, which is denominated in dollars and actual supply of dollars. So if I were to try to channel Jeff's perspective here, I would say something to the effect of, well, actually the largest market for dollars is the euro dollar market, which is really tough because it's not fully understood how large that market is, but maybe it's an order of magnitude, call it larger than the market for dollars issued by the Federal Reserve, right? So you've got all these overseas banks, and they're issuing credit that's denominated in dollars. So, what would you say to this idea that maybe it doesn't matter quite so much that foreign central banks are decreasing their holdings of reserves in dollars, right? Because really the more important driver is this much larger, much less transparent market that demands certain amount of dollar-based collateral, right? So essentially you've got this huge non-transparent market in the form of Eurodollars, and that's creating this constant bid for especially treasuries, which is just going to continue to prop that entire system up. So what would you say to that kind of argument?
Yeah, I mean, I don't know that the argument is counter to what I was saying. I guess Jeff's saying that there's a structural mismatch in terms of supply and demand for dollar that is bullish for the dollar.
Right. That's exactly.
Yeah, so yes, I agree with that. Prior to everything I said about the sea change in monetary and fiscal policy here in the U.S., the reality is that if you study sort of longer term cycles through the lens of something like Neil Halsforth, turning my former colleague at Hedgeye, or Peter Turchin, I believe at the University of Connecticut, he wrote a book called Ages of Discord that's really good on longer term cycle work. If you sort of think about the political cycle in the United States of America, it dictates that we are going to have fiscal largesse. And what that means is it's no longer unipartisan. It's no longer AOC and her buddies on the far left. It's everybody wants free money.
Agree.
From government now.
Yeah, I agree.
And it's bipartisan. And so the parties that don't realize how bipartisan fiscal largesse is incrementally becoming in recent years, or it has incrementally became in recent years. Obviously, the pandemic exacerbated a lot of that. That change is meaningful because it means that at every opportunity. Midterm elections, just like we saw with Georgia in the Senate race, as weird as that was to a lot of investors for Georgia to flip double blue, it actually is not in the context of the Gini coefficient slide that I highlighted, right?
Right.
Like this is why Georgia's flipping double blue. People want relief. They've been squeezed by inflation that has been underreported for 2-3 decades now. They've been squeezed on the income side, on the nominal income side, by globalization, by China, by private equity, by a lot of factors have really kind of made life as a middle income to lower income person in this country quite miserable for the last couple of decades. And so I think that the political response in terms of just turning that dial, we're now debating $1 to $1.5 trillion budget deficits in peacetime. Like we're no longer debating like, oh my God, $1 trillion, we got to get back to $500 billion like we were in the post-crisis era, like with Paul Ryan and Rand Paul and things of that nature. Now the fiscal hawks at DC are like, all right, let's just get it to $1 trillion. And to me, that's a meaningful shift in terms of the supply of dollar-based credit that's going to hit the system over the next decade.
One of my favorite documentaries of all time actually is Smartest Guys in the Room. It's a documentary about Enron, the Enron scandal. And it was obviously made back in the early 2000s. And, the association that most people have in their mind is this colossal fraud, Enron, like massive amounts of, shareholder wealth or capital being destroyed. Enron back then was like $90 billion, something like that in market cap. And you kind of look at that now and you're like, oh, doesn't seem like that much. 90 billion? Like, it's almost like a rounding error. And I think it's just such a good reminder of just how drastically the relative amounts of dollars that we're talking about has changed over the course of not that long of a period of time. It's pretty crazy.
This is why I was actually showing slide 56 in the previous question. This is showing the blue line. It shows the G4 central bank balance sheet relative to Bloomberg World Equity Market capitalization. Sorry. The whole world has figured out that you need this QE game to keep going, for the system to work. And I would argue, as Jeff argues eloquently, the system isn't working for the most number of people.
It's not.
For the average person, it's not working. However, for investors, the system's working quite fine as long as they keep priming the pump on asset purchases. When they pull back on asset purchases, we always run into problems with asset markets because there's too much existing. The stock of existing credit outstanding is way too high. We're all amortizing corporate debt, personal debt, government debt. All that money, all those cash flows is going to amortize that debt. So you need QE to truncate that amortization process and actually put cash into the real economy or cash into asset markets for them to continue appreciating. And so that's why we're also hooked on this QE. That's why the patient can't survive without the drugs.
Yeah, there was again, I'm going to get in trouble trying to summarize other people's points, but this guy, Mike Howell, came on my colleague Tyler Neville's podcast, and he basically made the point that capital markets, especially U.S. capital markets, have shifted from a capital allocation machine to a refinancing machine. And if you look at flows and what where banks are essentially getting their fees these days, it's actually rolling over the tremendous amount of debt that exists. And even though, the fees that they generate are pretty low, on a relative basis, just the sheer amount that needs to be rolled over and refinanced is tremendous.
Yeah, no, you're talking in orders of magnitude where we were prior to the GFC.
Yeah.
And obviously even prior to COVID. What I'm showing here in this chart here, there's four big forces that we care about when we talk about long-term investment cycles.
Right.
There's demographics, there's leverage, there's balance of payments, and there's politics. So we talked about balance of payments and politics, and to some degree we talked about demographics with respect to some of the drivers of U.S. disinflation. The fourth of those topics, or those pillars rather, is leverage. And so how we study leverage, or the leverage cycle, is looking at the change in the private non-financial sector credit to GDP ratio relative to the change in the private non-financial sector debt service ratio. And as you can see from this chart here on slide 57, every economy, just like they did in previous cycles, dealt with COVID the same way that we've done with all the most recent cycles, which is extend more credit. Just extend more credit. We'll do more QE. We'll put cash into your hands, and we'll force you to allocate that cash to to companies, businesses, and governments that need the credit. That's it's like kick the can down the road, extend and pretend. It's only a pandemic. It's only a financial crisis. It's only a tech bubble. It's always only something, right? But we're to Jeff's point, and he's done a tremendous amount of real seminal educational work on this topic. It's that we created a Frankenstein of a system that needs incremental leverage and incremental cash flows to support that leverage to function. If you take the patient off the drugs, the patient has a big problem. We have Q418, we have Q1 of 2020, we have 07, 09, you have 2011, you have all these sort of moments in time. Obviously, we talked about the 2010 and 2011 events, where if you just take the patient off of drugs, even if only temporarily, we have big problems in the system.
Yeah. Howdy, guys. Excited to talk to you a little bit about this week's sponsor, Matrixport. If you're like me, you're trying to figure out how can I make my crypto go as far as it possibly can. Well, Matrixport makes it really easy to do the simple stuff like just buying and trading, and you're holding your crypto on a secure platform that you don't have to worry about. But they also help you take that next step to doing things like getting loans against your crypto or earning yield on it. Let's talk about the yield part, because for me, that earn feature is the most interesting thing that they do. Number one, first step, you can start earning up to 30% APY on your USDC deposits. That's about 29.99% more than if you just kept those funds in a bank account. Talk about a no-brainer. Number two, their team walked me through this. They have made accessing DeFi easy. And guys, I am telling you, I am the biggest Luddite on the face of the earth. If I can understand this stuff, then I promise so can you. So don't wait. At least go check them out. Click the link at the bottom of this episode. Thank me later. So a lot of folks that I've spoken to, just because people look at the world through their own lens, so they have a lot of different language to describe that exact problem that you just outlined, right? So this will have been released by the time this episode airs, but Alfonso Picatiello came on our show last week, and the language that he used to describe that exact problem is there's a difference between structural growth and cyclical growth, which is driven by credit, right? So there's certain growth expectations that are baked into the economy. The easiest way that I have of understanding that is the largest pool of institutional capital that exists is pension funds. They have a certain target that they need to meet, which is like around 7%, right? So at a certain point, it's just politically or socially unacceptable to not be growing at a certain rate, right? And I think if I learned one thing from COVID, it's that A, we're not operating in free markets, but B, asset prices are at least to some degree a political decision, right? And if you want to question that, ask what you think would happen if the Fed stopped their $120 billion in monthly asset purchases, right? There is somewhere a political decision being made that asset prices should be higher than what they are right now. And
of course,
right? It is. It's just a simple thought experiment.
It's not. I'll interject. It's actually not a simple thought experiment. It is the truth. And so what we're showing here in this chart here is the red line is the S&P 500. The blue line is the S&P 500's earnings yield deflated by headline CPI. So the real earnings yield of the S&P 500. It's, as you can see, very deeply negative right now. Mm-hmm. The five of the last 6 times this thing has gone deeply negative, i.e. inflation got out of control to the point where we had negative earnings yields, we were on the precipice of a giant collapse in the stock market. 5 of the last 6 times. I mean, this is data going all the way back to 1970. And so we're in that moment now. And so it is a political choice because these guys have to keep their foot on the gas unless, if they take their foot off the gas, then they're exposing asset markets and the economy to the actual cycle. And this is the cycle.
Right. Yeah. My question is, so I've asked this question in a lot of different ways to a lot of different people. So I'm going to ask it to you too. How do we reset here, right? Because you're absolutely right that we have been kicking the can down the road for a long period of time. So generally when I ask this question, people are like, well, we're going to continue to kick the can. Okay. Do you philosophically believe that that can happen forever, right? Or are there just breaking points, right? Where, like, to use a not even totally unrealistic example, the price of homes so my parents just moved to Bozeman, Montana. Congratulations, Mom and Dad. The average price of residential real estate in Bozeman is up something like, it's just under 100% year over year, right?
Come on, 100 doubled?
Yeah, it's insane what's going on over there. And I get Bozeman's like it's a hot area, whatever. What is it?
Whatever, dude.
Whatever, man. Whatever. Like the average median price of the house in the U.S. was up something like 18% last year, and it's supposed to be like 12% this year. So what happens when we wake up and houses cost? The median price of a home in the United States costs $1.8 million, $2 million. I mean,
we're already seeing that. And so I'll go back to the Bozeman example in a second. We're already seeing this. So this chart here on 53 shows the relationship between home price appreciation through the lens of the Case-Shiller time series and owner's equivalent rent. Well, right now we have home price appreciation up 16.6% on a year-over-year basis nationwide. So this is concluding whatever the opposite of Bozeman is. It's probably like, I don't know, Bridgeport, Connecticut. It's probably like down year over year, but so up 16% year over year. And so the reason I highlight this analysis is because it implies, historically speaking, when you've seen the spread between home prices and owner's equivalent rent peak, when that spread reaches a cyclical peak, you typically have, owner's equivalent rent and shelter CPI catch up on a 12 to 24 month lag. And it makes a lot of fundamental sense, right? You price people out of the home ownership market, or people sell their homes and actually go into the rental market to capture the upside and the price appreciation. Either way, what we're talking about is persistent housing type inflation accelerating housing inflation over the intermediate term, and that's exactly what our models are calling for with respect to shelter CPI. So, going back to the original question, like, how do you kind of hit reset? I mean, the answer is there's only 2 ways to do it. Dalio sort of introduced this framework, this concept called the beautiful deleveraging versus the ugly deleveraging. I don't believe any government has the political will to pursue the ugly deleveraging, right? You're not going to be in office, particularly in a society where we're electing presidents every 4 years. The election cycles basically every 2 years. The presidential election cycles every 2 years. The midterm election cycles every 1 year. And so you're never going to have a core constituent of policymakers and a core constituents of voters who believe in causing that much economic pain, or more importantly, I should say, they're incentivized to cause that much economic pain. And because the only thing worse than having a long-term malaise, if you're a middle-class American, is actually having a protracted, a shorter term but really sharp, deep, malaise. Imagine if we went to COVID and we didn't hand out checks. We basically told people to go sit at home and not make money and didn't give people money. Imagine what that would have actually felt like for a lot of families in America. So that's what we're arguing for when we talk about a nasty, ugly deleveraging. And I just don't think there's a political will to pursue that policy.
Yeah. So maybe to sum up, if I could, everything that we've talked about, I totally agree with you. All these kind of roads, especially in macro land, kind of lead back to the future of the U.S. dollar. But if you just kind of look at the last 50, 70 years, however far you want to go back, we've essentially been putting pressure on the dollar, right, and kind of relying on that and its status as the reserve currency, and trade is denominated in dollars, so there's always going to be this kind of resting bid or demand rather, for it. But now we're essentially putting pressure on that and really testing the limits of how far that can go. Is that kind of an accurate summary of what we're talking about now? Because I'd love to get into how can investors prepare themselves, right, for the environment that we're talking about. If it's imagine I'm in a seat where I'm trying to make investment decisions. How do I prepare for this environment that we're talking about here?
Yeah, so that's an outstanding question. I think the number one thing you have to do to prepare is have an understanding of where you are in the broader cycle. So this goes back to not only understanding, okay, where are we in the context of a global currency cycle? Where are we in that supply demand imbalance for dollar based credit? We happen to think we're on the precipice of a real relative, imbalance of dollar supply,
Right.
Over the next 5 to 7 years. At least do we get to the, the other side of this current foreturning that we're in. And so that likely means we're going to have a down dollar over the long term, over the next, 3, 5, 6, 7 years from where it is currently. That likely means we're going to have higher asset prices, or not necessarily higher asset prices. Certainly you'll have higher commodity prices, but it's also likely that we'll have higher asset prices to the extent that the Fed is, aiding and abetting that transition.
Right.
If the Fed is not aiding and abetting that transition, and we have a lot of economic start-stop associated with that process, then you're going to have, you could potentially have some meaningful downshifts in the prices of equities and credit, along the way, as the kind of the market. I like to think of asset markets as being living, breathing organisms. When the Treasury Department needs its money, if it's not going to get it from the Fed, it's going to cause a sell-off in other asset classes to capitalize itself.
Right.
For the Fed to come back into the game. So the market is smart in that regard in terms of creating this almost Pavlovian response out of policymakers. And then lastly, along the way, I mean, if you're a long-term asset allocator, that's all fine and dandy, but a long-term asset allocator buying every commodity chart at the beginning of June would have got his face ripped off and quite frankly removed from the seat that they're sitting in. And so this is why I go back to the cyclical component of what we do. It's about understanding the rate of change cycles of growth and inflation and realizing, hey, when you're at a cyclical peak of something like growth or something like inflation, this is inflation here, this is growth, we're coming off cyclical peaks. And so that augurs for a much more defensive sort of, much more defensive asset allocation over the intermediate term. That doesn't mean you need to take your long-term portfolio from 100% commodities to 100% bonds. Obviously, you should never be in either of those
Right.
Setups. I'm just using that as an example. It just means you need to start making decisions at the margins to book gains and things that aren't going to work over the next 3, 6, 9 months, and really have capital to rotate into things that will work. And then at the end of that process, by the middle of next year, you're going to be buying a lot of the commodities and things of that nature that you made money on in the first half of this year, because the dollar can really start to break out of its consolidation in a meaningful way to the downside.
I'm going to ask you a bit of a tricky question here, but because I tend to subscribe to your explanation here, right? Like it's almost like don't think about it too hard, right? When there's this much currency debasement that's going on, hard assets, honestly, like real estate, like commodities, gold, should tend to do really well. What is the devil's advocate view there? Why could that understanding of the world be wrong or incorrect? Or kind of what's the counter argument to everything that we just laid out?
Well, I think the counter argument is that price begets more supply. And so, I think that's something the crude oil marketing is struggling with right now, to be frank, is that, when the prices get high, it incentivizes more people to drill for natural resources. And so, you typically, that's why you don't have these sort of long-term, like 8, 10, 12-year moves in commodity markets. They tend to be like 3 to 5 at most, right? You get massive bubbles over a 3 to 5 year period, and then that's when all the incremental supply starts to come online and really starts to depress prices. So that's sort of the devil's advocate view. But again, I don't believe that the devil's advocate view is powerful enough to override these sort of longer term currency and debasement dynamics associated with this sort of lurching left of monetary and fiscal policy. Now, again, I mentioned earlier that monetary policy, part of the reason the reflation trade ended, when it did in the middle of this year, is twofold. One, the growth and inflation, the rate of change cycles for growth and inflation were peaking and rolling, and we're obviously observing that in the data already. But number two, it was the Federal Reserve that sent a signal to investors via its dot plot, and really through a lot of commentary that we've seen since then. Kaplan, Bullard, Bostic, they're all, Esther George, they've all made very hawkish comments since then. Part of that is the fact that the Fed basically said, hey, look, we might have adopted these two new frameworks, but we're not going to be this sort of perpetually easy MMT financing, central bank that you thought we were going to be. We're just not, at least not yet. We probably need another economic and/or market event to catalyze that real shift left. Or more importantly, you could see someone replace Powell in February of next year.
I think that supply demand as well, when you're talking about commodity cycles, is just super, super important, right? And actually, with that supply dynamic and bring more supply online, I actually want to ask you about moving to a crypto question here for you. But when you look at an asset like Bitcoin, right, where do you think that? What's your macro sort of view on crypto in general? Do you think it has a place? And do you view it as almost like a an attempted new safe asset? Do you kind of subscribe to that whole, like, it's a new alternative to gold? Like, what's your just kind of view on crypto in general?
Well, I'm proud to see that the narrative around Bitcoin is, in my opinion, appropriately changed to digital gold, because as we all know, like the environmental impact, there's so many reasons why it's not a good currency, and I think I'm glad that the thought process around that has shifted, because it really, in my opinion, I think it opens up it opens up the asset class to other institutional investors.
Yep.
Just in the same way that we saw with gold's institutional interest really took off in the early 2000s. I think we're kind of on the precipice of something like that with Bitcoins. But to answer your question, of course, I believe that it has a role in any portfolio. So, in terms of how we think about the world from an asset allocation perspective, we're what we do at 42 Macro is we sort of help investors, orient their longs and shorts really through the lens of what you're long, not what you're necessarily short, but what you're out of, from the perspective of the 5 liquid asset classes: U.S. equities, global equities, commodities, fixed income, and currencies. And we do that through the lens of what we call our grid asset market back test. That's nomenclature, but it's really just designed to say, hey, what's the expected return and percent positive ratio for everything I can tell that I can shock the system with, from the perspective of what we think about the economy, what we think about policy, what do we think about sort of the rest of the world, economic developments and things of that nature, and then what is the risk, what's the volatility, what's the covariance. So we're quantifying all of this stuff and actually creating visualizations that help investors to say, hey, this is where I should be allocating capital at the margins, this is where I shouldn't be allocating capital at the margins. And right now, in terms of how we have the commodities back test set up, I believe that's on slide 111. Let me jump you to there. So this is annualized expected return. So I mentioned that back testing process. So we have D for deflation. That means growth and inflation are trending lower. We don't think growth or inflation are slowing sharply, so we have a 0 sigma deltas plugged in there. We have policy balance sheet tightening at the margin coming up. We have fiscal policy. We'll be tightening fiscal policy for extended period of time, just based on the size of the hole that we blew in the budget deficit in the first and second quarter of this year. And then lastly, we have the rest of the world. So we factor in all that information on a 25-year look back to get you to those scatter plots that we highlighted. Particularly, I believe commodities again was on slide 98. So Bitcoin in particular, again, we just show the ETF as a proxy for the underlying indices. Bitcoin and Ethereum are actually quite low risk relative to where what you would expect from other commodities in the context of that analysis. And in my opinion, I think that's why you're now starting to see more funds flow back into crypto as a function of this transition to all of those economic and policy developments that we highlighted in the backtest.
And one of the components just of growth thing you highlighted before was just demographics in general. And I do think it, I don't really necessarily, people subscribe, or people say there are a lot of differences, right, between like the millennial generation versus like Gen Z or Gen X versus Boomer, et cetera. I think that most generations tend to be pretty similar. That being said, I do think there is actually a market preference for digital assets like crypto, Bitcoin, Ethereum, et cetera, from a younger generation. So I just see these huge tailwinds for the asset class in general. And I really do think I am very sympathetic to folks that are skeptical about crypto in general. I totally understand. I think it's actually more about volatility really than anything else. But I do think if you dig deep enough on most criticisms of this asset class, what you end up finding is that there's a certain group of people, you just can't touch it. Right? It's digital. And to a certain demographic of folks, that means it's not as real as something that you can touch like gold. But I think for a whole generation of, especially, people look at me and like, oh, you're a digital native. I don't really, not really, not compared to, Gen Z and what they're doing. I mean, for them, it's almost more real if it's online. And
it is more real if it's online.
It is.
That is the world.
That is the world.
Yeah, it's almost like we're getting to the place in the development of that generation where real and not real is a distinction without a difference. Like there's almost no difference between the two worlds. One is the physical realm where I eat and I sleep and I drink water, and the other one's where I do all the stuff that actually actualizes me from a human being perspective. And so I think you're increasingly for that generation and generations to come, things like the concept of a digital asset. We're not even going to have the conversation after a while.
Yeah.
Right? Like for me, it's always been a digital asset. Like I've never walked into, like if I buy some shares of Apple, I'm not going to walk to, where's Apple out in California? Anyway, Cupertino. I'm not walking to Cupertino to grab the building.
Yeah.
No, it's a concept of, I have a share of the company. Like that's, so to me, it's like, I think you're absolutely right in terms of that generational divide with respect to Bitcoin and Ethereum. But the reality is that part of it is the volatility of the asset class is quite high. And so the older you are, the less likely it is that you can actually have exposure to an asset that's that volatile. If you're living on some fixed income or something close to a fixed income, you certainly can afford to have an 80 vol asset or a 100 vol asset, taking up a meaningful chunk of your portfolio. So we understand those limitations as well.
Yeah, I think the volatility of crypto as an asset class does a lot to explain just the It explains a lot of stuff to me, right? And especially having lived through it now for like 4 years or something like that. Volatility breeds evangelism. I don't know if that's the right word. It really does, because in order to stomach, right, 80% drops and to not sell, the way the human brain works is, right, you have this emotion and then you kind of use rationalization to justify why you've done what you've done. So everyone I don't care, these people who are like, we're diamond hands. If what you're holding drops 50 to 80%, you feel an emotion because you're a freaking human and you're not a robot. And then all of the cerebral part of your brain kind of ascribes this logic to it, right? But it really has this effect of hardening resolve over periods of time. And I think if you look at gold and kind of the community that's grown up around gold, look at gold after it went off in like the 70s, right? It went from, I forget, like whenever it went off, it became legal for Americans to own again, it went from like $35 an ounce way up to, I forget, it did like a 20x or something like that, $700 an ounce. And I think that period of time, if you look at a lot of the folks in the gold community, they were growing up when all that stuff happened. So that was a big aha moment for me. I was like, why do these people have such ardent beliefs about this? And it's like, well, they went through a huge period of volatility and it just bred it into them. But I see you've got great quotes up here. Daniel Kahneman, big fan of him.
Huge fan. And I was actually going to read this Danny Kahneman quote because I think it speaks volumes to both the gold bug community and also the crypto bug community as well, or what do you call it, the hodlers as well. So if you don't mind if I read
the crypto bug community, that's God, I've never heard that, but yeah, it's fair.
Your approach, folks.
Yeah.
All right, so this is a quote from Thinking Fast and Slow. It's page 212. By the way, if you haven't read that book, the first thing you need to do after hearing this podcast is go
read that book. Yeah.
Subjective confidence in a judgment is not a reasoned evaluation of the probability that this judgment is correct. Confidence is a feeling which reflects the coherence of the information and the cognitive ease of processing it. It is wise to take admissions of uncertainty serious, but declarations of high confidence mainly tell you that an individual has constructed a coherent story in his mind, not necessarily that the story is true.
Man,
that it's crypto and gold bugs in a nutshell.
One unbelievable quote. So one of the things that sticks out to me in that quote is the cognitive ease of processing it. So people don't necessarily think about this. This is starting to come up in like the VC community, the attention economy. So as it turns out, attention is a finite resource. In people's brains. You do not have an infinite amount of attention. That's why actually people, when they're going through stressful periods in their life, tend to gain weight, because there's only so much like attention and like discipline, right, that you can have at one period of time. So if you're really focused on something has to give. That tends to be eating standards. So just a little fun fact there. But basically everything has evolved from a cognitive standpoint to decreasing the amount of processing power that you have to do, right? That actually weirdly makes your brain more efficient in a lot of ways. So, man, so basically that really explains to me when people just have this like evangelical belief, you can't shake it because I don't need to think about it. I just know that this is true. I've accepted this truth. Boom. Man, what an unbelievable quote that is right there.
Yeah, no, you're absolutely right. And I think, one of the things that we've done here is that probably the best thing that we've done here is actually, through the lens of that regime segmentation process that we highlighted from what we call our bottom-up macro regime segmentation. But we also have our top-down dominant market regime view. So we're constantly now casting what grid regime the asset markets are pricing in. And more importantly, what grid regime that they're likely to price in based on those bottom-up economic views. And so, what we're really doing here is just selling people cognitive ease. Mm-hmm. Like, you don't have to go out and bean count every time series to figure out what's happening economically. You don't have to go out and bean count and score the measure map, the volatility and price changes of all these different market-based indicators to figure out what grid regime the asset markets are in. It's all about sort of reducing reducing the computing power, the processing power, more importantly, the time with which investors need to spend processing all that information. This is why we think about the word of regime segmentation, because it reduces and restricts the range of probable outcomes to a much more manageable slate for investors.
One question that I had for you, Darius, and then I know we got to start winding down. You've already been super generous with your time. If you go back to that regime that outlined the 4 quadrants, now, where would you place stagflation here? If you
Bottom right.
Bottom right. Okay. Do you make any distinctions in between like a stagflationary versus inflationary environment, or are those two how do you think about those two possible outcomes?
Probably, to determine, just as an example, determine like one of those dots, you're probably looking at over 10,000 data points to determine the placement of one of those dots. Yeah. So there's a lot of summarizing in terms of what we do here at 42 Macro for investors. But to answer your question, yeah. So when you're in that bottom right, that bottom right regime there, when growth's decelerating and inflation's accelerating, at the margins, that is stagflation.
Yeah.
And I think investors also think about stagflation from the concept of high inflation and low growth. Like that is also, historically speaking, stagflation. But in terms of asset markets price that in, what matters is the change at the margin. Are you going from high to less high? Or are you going from high to more high? Are you going from growth to slow growth to no growth? Or are you going from slow growth to some growth? Those deltas, those changes at the margins, are where 95% of asset market information is contained in terms of if you do a principal component analysis of various asset classes.
Yeah, absolutely. So I guess just to wrap it up, Darius, we've covered a lot of the ground, and thanks for being so generous with your time. Any parting thoughts for folks listening to, let's say you're, from the perspective of someone who's kind of maybe in the older generation, managing for retirement, these could be interesting times, could be somewhat concerning times, right? So just any parting thoughts on everything that we sort of covered so far.
Yeah, so a couple of parting thoughts. So these are interesting times and they are concerning times, but they don't necessarily have to be concerning to the place where you need to run out and raise a bunch of cash, right? Like we already seen record cash balances amongst investors. That's on slide 90 here. Let me take you there. So we're right here. We're all-time highs in the stock market, just an unrelenting bull market, and yet throughout that entire process, investors, through the lens of money market fund assets, have been, kind of sitting on their hands. There hasn't been as much participation in the asset markets that you would have expected because of that, because times are so interesting. We got a pandemic going on. We got China doing whatever the heck it wants to do. We got Russia undermining elections. We got people storming the Capitol, people marching all across the country. It's been very difficult for investors to sort of handicap all this risk. And so one of the things that we do again here at 42 Macro is really just help them quantify that risk. The chart on the right shows these are two of the most important charts in the deck from the perspective of managing drawdown risk.
Right.
One is the relationship between the VVIX, that's the volatility index, and the VIX, the S&P 500 VIX index. When that ratio breaks to bearish, it's a get the heck out of Dodge market, in so much that when our cross-asset correction risk indicator breaks down into the low 20s, high teens, that's also a get out of Dodge signal. So right now, neither of those signals are suggestive that investors need to be as bearish as that cash chart highlighted. So that means you can continue to take selective risks in the equity and credit markets. We've been quite bullish. Really throughout, since going all the way back to the spring of last year, and there's really no reason to have gotten off of that ship as a function of both of what happened in the economy, going back to that colorful table on slide 5, but also how policy dynamics are evolving to support further asset price appreciation from here. So, I guess that my parting thought would be, take everything you read with a grain of salt. Things don't happen in a straight line. If I mentioned that comment on inflation, the stationary mean of inflation being transposed higher, it's not, the markets aren't going to realize that it's been transposed higher all in a straight line. There's going to be a time period where we disinflate for 12 to 15 months from here, from the most recent data points, and at some point towards the tail end of that process, that's when the markets will start to say, hey, no wait, this dollar is really moving to the downside. We got to go reallocate back towards commodities and things of that nature. So understand cycles is probably the most important thing I can leave your investors with.
Absolutely. And Darius, if folks want to find out more about you or 42 Macro or follow the work that you do, what's the best way to do that?
Yeah, so obviously our website, 42macro.com, but I'm also on Twitter at 42macro Dale, DDALE, and then we have our 42macro handle as well.
Awesome. All right, man. Thanks so much. This has been super enlightening, and thanks so much for making the time. Hope to do it again soon.
Appreciate you, brother. Thank you so much.
You too, man. Take care.